What can a Century 21 agent do for you? They explain the market, love a good barbie and never drink milk from the carton. They do your homework, your legwork and sometimes yard work. So invite one over. Century 21 agents. Smarter, bolder, faster.
Welcome back to Your Property Empire. Now, joining me on the show tonight is Lee Hatton, CEO of Eubank, and we've just been joined by Charles Tarbey, Chairman and owner of Century 21 Australasia. Now, where have you been this week, Charles?
I have been everywhere, actually. I've flown from Brisbane to Melbourne, Melbourne to Auckland, Auckland to Wellington, Wellington to Auckland, Auckland to Whangarei. I've got to say
well done.
Whangarei,
well done.
which is north of Whakatane, which is that correct?
Yes, that's absolutely
And
correct.
then I hired a car and drove to Tutukaka.
Tutukaka.
And this is why you're so knowledgeable in the property market, because you're everywhere.
And I did. I saw a whole lot of the marketplace up there and got a lot of stats, got to talk to a lot of people about real estate in a very short space of time.
So
I had to get up at 5 a.m. to leave Tutukaka to get to Whangarei, to get back to Auckland, to fly to Sydney, to drive, catch a train from the airport. Anyway, you want to know about real estate today?
Exactly. How's it going in Tutukaka?
It's fantastic. What a great place. What a great place. No, the whole of New Zealand market's actually doing very, very well. Still very well. In fact, I was talking about a year ago, they thought they were in a boom. I said, I don't think you're in a boom yet. I think your boom is yet to come. And I think they're just going through it right now. Might be peaking a little bit in certain areas, but great marketplace. Lots of people keen on New Zealand, and so they should be. Beautiful place.
Sounds good. Well, Lee, before the break, we mentioned APRA and that a lot of the banks have been increasing rates. Have you seen that the property market has changed from your perspective with APRA making those changes?
Yeah, so I think a couple of things that we've seen is just the investor flow has slowed down. So
and that's what they wanted, wasn't it?
Yeah, look, I think it's done exactly as they expected it to. Whether it's come off harder and faster than they expected to is unknown, so maybe there could be some relief along the way if they decide to kind of revisit those terms. But I think the key thing is that what it's really encouraging is from an investor perspective to make sure actually that they're having a really good look at their loans. Parallel to that though, we've seen the owner-occupied market increase, right? So as we've seen investor come down, we've seen owner-occupied go up.
Your agents are obviously seeing people every day. Have they noticed a big change between the proportions?
There's some of the areas, definitely. It's certainly the marketplace has changed, and a lot of people are looking at it very, very differently than what they were a few months ago. So owner-occupiers have always been out there, just haven't been able to get into the game because of investors. So they're now able to, more so, because things seem to have stabilised a little bit.
And before the break, I was asking Lee about, obviously, a lot of the banks have increased the rates since the APRA stuff, or maybe they've used it as an excuse. You've got a broking business as well. Have you seen a big change from the mortgage broking clients?
I just think, well, I think the mortgage rates climb was wrong, and I'll still say it. I think it was incorrect to put a blanket increase across everybody. You know, they're trying to slow down the investors, but they've slowed down they've damaged the home buyers who went in good faith thinking things were stable, and all of a sudden they've been hit with the same increase as investors. I understand investors getting hit with it, but I don't understand why home buyers got hit with it.
But also interstate as well, because if you're not in Sydney or Melbourne, you'd be thinking, well, our market's going down, and we're speaking to a lot of people in the mining towns, and they're saying our properties are half price.
Half price, rents have dropped significantly because a lot of them bought properties based on the rental return they were getting, and the mining giants have all started to move out of places, so it's difficult. And then they've been hit with an increase in interest rates, and all of that's happened in a very short space of time. So somebody in mining town, they've had a massive hit in many different areas. No, I wasn't an advocate for that, and I still think that the banks made a mistake.
So this is exactly what happens when you try and make too much money.
We all want strong banks, but I think they're very strong anyway. I think so.
Release confidence, that gives me confidence. We talked about some of the trends for home buyers before the break. How are you seeing trends with the investors?
So I think probably the key thing is, I guess, that they're moderating in terms of their expectations. So I completely agree with you. You know, there are some rentals that are coming off in certain areas, but there are also, there hasn't been that kind of expected increase in rental returns. You know, I think investors are absolutely being realistic about what is achievable out there in the marketplace. That would probably be the key thing that we've seen.
Actually, Charles, because I had a call actually from someone in New Zealand today that had a lot of property in mining towns and it had gone down and they'd done every last thing to hold on. What's your advice to people in those markets? Sometimes should you be speaking to your agent to say, well, dump it now as quick as possible, or trying to ride the wave till it kind of bounces back?
I think some of the people can't dump it, Chris, because some of the properties may now be worth less than what their mortgages are. So they might be stuck. They might just have to ride this storm out, and that's probably the only way. Otherwise, they're going to get a bad credit rating. All sorts of things are going to go wrong.
But is it
for
still
them.
potentially, say if your property's minus 50 grand in negative equity, is it better to dump it now and cop a kind of caning from the bank versus wait till it's minus 150?
I know some people that have done that, and they've lost money. They've accepted the fact they've lost money. If you look at the RP data or CoreLogic reports that show the pain and gain, there's only about 8% of the total real estate population of buying and selling that lost money in the last few years. So a significant percentage have made more money, and I think that's been impacted mostly in those mining town areas. So some people have gone down that road. Personally, if I could hang on, I'd hang on, but I don't know what I'd be hanging on for right now. I'd be hanging on for hope that maybe something might change in the mining industry, which it can. Now,
on a slightly different topic, for first home buyers, we did some articles and the Telegraph talked about rent vesting. It's like rent where you want to live and invest somewhere else.
Yeah.
Are you seeing a lot of first home buyers not buying their first homes these days?
So at UBank in particular, we only lend to people that have more than 20% equity. But kind of in researching the topic, because we look a lot at the new millennials, and what we're actually really interested in is what could happen for them with the first home buyers grant. So first home buyers grant for investing, because you're probably aware at the moment with first home buyers you have to live in the property for the first year or 6 months or a year to be able to qualify for that grant. So we're actually quite interested in what kind of influencing could go on to encourage some investing.
So certainly look at a different way. Let's jump into the numbers, Charles.
oh, lovely stats, 59.2% clearance rate for the week. When you look from a national level, 63.7% this time last year. So it's almost back to where it was, back to even again. Sydney actually was pretty bad, at 55.6%. Haven't seen it there for a while. But the star, Melbourne came in at 63, but the star of the show this week is Adelaide at 70.8%.
It was Canberra before, and now it's Adelaide.
Canberra came in second, but Adelaide 70.8%. So it's a battle between Canberra and Adelaide as to who's leading the field over the last few weeks. They've done very, very well. So clearance rates are down, as expected they would be.
Now, homes advertised for sale, are people still putting the properties on?
Declining in the last few weeks because of the Christmas period, so it's down 0.98% this week over this time last week. New Zealand, however, they had a different figure. That was up plus 0.02%, mostly in Wellington and Auckland, where the listings were. Most of the other parts of the country had a decline. Now, Wellington and Auckland are really doing very, very well. They're still very strong markets, so the fact they're getting some stock on there is a good thing for them.
Wonderful. And what's happening to the rents?
Yeah, well, that was what we were talking about before. You know, we started the year at a certain level, and guess what? We're exactly where we started, almost to the cent. Now 12 months later. So there's been a zero change year to date, but and that's because Sydney had a negative 0.28% over this time last week. Melbourne had a negative 0.22%, and our lovely Brisbane had negative 2.1%.
And just finally, the vacancy rates?
2.63 for Sydney, 3.56 for Melbourne, and 6.6 for Perth, giving us a total of 4.26% average on those.
Wonderful.
Rates,
And very quickly, outlook for the rest of the year?
Rest of the year, lunches and Christmas parties.
Perfect.
So thank you, yeah.
Perfect thing to end on. Charles Tarbey from Century 21, Lee Hatton from UBank, thanks for joining us.
Thank you.
Thanks for joining us at home. Next week will be our last week for this year, so definitely tune in and we'll give our predictions for the rest of 2016. Until then, I'm Chris Gray. Good night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.